something scary just happened in the Indian markets. Take a look at this person. Do you know what he said?
I think this is the most dangerous year after 2007-8 from looking at 10-year point of view. We think it is a clear time to take out lock, stock and barrel from small and mid cap.
Now, that's no ordinary man. This was the Chief Investment Officer of ICICI AMC S. Naren sir. He is responsible for how ICICI Mutual Fund invests your money. That's nearly 6.5 lakh crores of public funds. The organizers of an annual conference in Chennai called IFA Galaxy, a local mutual fund association, posted a video of S. Naren sir talking about how bad the small cap and mid cap situation has become. And you know the worst part? He also said something that really makes us question, is the ever popular wisdom of an SIP being the perfect tool for investing for the common man even real?
Should I be stopping my SIPs?
Are your small and mid-cap investments safe?
If some investor has 5-10 years horizon, he should definitely put money in small cap.
Today we'll break down what Mr. Naren said and what it means for you as someone who invests in the Indian markets. My name is Aditya Iyengar, CFA. Welcome to Personal Finance TV. Let's get started. Okay, I'll be honest here. What's actually great is that as someone who heads an AMC, he was incredibly candid about the situation. Even though AMCs make more money when investors are bullish and continue pumping money in the markets. The primary reason why he thinks 2025 is as dangerous as 2008 is that the business risk is now being taken by you and not banks. It may sound a little complicated, but here's the deal. Back in 2008, companies would over-leverage with the help of bank loans in order to start new projects or carry out acquisitions of smaller companies. But times have changed now. They prefer doing the same thing with investor capital via IPOs and rights issues. As a result, the balance sheets of banks are very fantastic in the words of Mr. Naren, as they are taking little to no corporate risk. Basically, the way to expand has gone from debt to equity, and hence the risk has transferred from the creditor to the shareholder. Meaning the ones who do innocent little SIPs in mutual funds like you and me. And obviously this isn't a bad thing. It's okay to let companies take risks with our money. That's basically the point of investing. But only as long as valuations are sustainable. Back in 2013 and 2014, valuations were very low. But now the average PE for mid and small cap stocks is around 43 times earnings. And that's mainly because people are investing in all these funds in hopes of faster growth left, right and center. And here's the thing. Let's say you invest in a small cap fund. The fund may be discretionary, where the manager is free to make choices as he sees fit. But you need to understand that his hands are tied when it comes to this aspect. He has no choice but to buy more and more small cap shares even if he believes that they are overvalued. That's because every mutual fund has a mandate and the manager is obligated to stick to that mandate. And what's happening now is that the profits earned by these companies aren't growing proportionately to their stock prices. And this has in some ways begun another vicious cycle. Because small and mid cap valuations are sky high, companies are more likely to do an IPO or a rights issue at premium valuations as it offers the founders more lucrative exit opportunities. Firstly, this increases the risks for retail investors and they also have to face a dilution. Basically, every time a company issues more equity, your proportionate share in that company's earnings becomes lower because earnings per share decreases when the total number of shares increases. As Naren sir calls them, junk IPOs. Now, I know what you're thinking, but I do an SIP. I invest a little bit every month. I'm averaging my cost. Isn't that the best way to keep risk away in the long run? Didn't all of those mutual fund Sahi Hai campaigns teach us just that? Well, yes, kind of. But Naren sir pointed out a critical issue with this practice. He said that ultimately SIPs are also investments in the market. If you do it in the wrong product at the wrong time, you're also headed towards trouble. He gave great examples. An SIP done between 1995 and 2002 in mid caps in India would have returned negative. What he meant was SIP during an unfavorable cycle, which by the way can last 5 to 7 years, can actually be bad for you instead of good. He said that SIP works best in an undervalued or volatile asset class, meaning if something keeps going up for a long enough time, the SIP in that asset may not make sense because the averaging keeps happening upwards. Contrast this with when an asset goes both up and down, but up in the long term. In this case, the SIP works in your favor because you're getting a better average. Now, the troubles are by no means over. There is another huge challenge here, and that is illiquidity and market impact. Naren sir gave a crazy example. He said that if a mid-cap fund has an AUM of 80,000 crore and the fund manager realizes a mistake concerning a stock that makes up 2% of the entire fund, then now the fund would have to sell shares worth 1600 crore, which is a substantial amount for a small or mid-cap company. These are companies with small market capitalizations, so when a fund sells a large portion of such a small company, it quickly creates extreme supply of shares in the market and causes the stock price to fall rapidly. You need to understand that selling a stock in the small or mid-cap space for a mutual fund is very challenging. In fact, many small and mid-cap mutual funds don't want their AUM to grow rapidly because of these issues. He also mentioned that India hasn't seen a redemption cycle since 2022 where investors kept pulling out money from mutual funds over an extended period of time. Basically, analyzing whether the funds we invest in are capable of handling redemptions is another question. Now, momentum is another factor that needs to be considered when securities rise in price due to a trend. Naren sir mentioned that the momentum for small and mid caps has also been breaking down lately and isn't a reliable indicator. What he meant by this was if prices are rising continuously and momentum favors that, then it makes sense to invest. But that hasn't been happening lately. So what now? Does that mean we stop doing an SIP going forward? Okay, realistically, not everything is scary. Naren sir also said towards the end of his talk that the only way to beat this is over 20 years or so. He specifically mentioned that 20-year SIPs would definitely not be negative, but it would be a challenging road ahead given the current situation. And he also gave some real talk. He asked how many people actually don't get scared when they see such negative returns after a few years of disciplined investing. Right after saying this, he also mentioned that in his 35 years of experience in the markets, there aren't many people with 20-year SIPs. Now, Naren sir thinks that at this time, hybrid funds or multi-asset funds with gold are the way to go. On the other hand, Radhika Gupta ma'am of Edelweiss Mutual Fund called this fear-mongering. She said that there's nothing better than an SIP in a decent fund with a balanced manager for the everyday investor who doesn't understand market cycles, valuations, or other fancy stuff. And you obviously know what Warren Buffett has been preaching for the longest time now. Be greedy when everybody else is fearful. Mutual funds in the end will always have access to the best research and the most meticulous analysts to pick out great stocks, and over long periods of time, being greedy during downturns might just pay off. What do you think though? Would you continue doing your SIP in small and mid caps? Let us know your thoughts in the comments below. And if you learned something new, please leave a like and subscribe to Personal Finance TV. I'll see you in the next one.